Welcome back to the Global Ledger. I'm Justin. Over the last several episodes, we've explored the architecture of liquidity, funding, and money creation. We've talked about the hierarchy of money, the repo market, and the dealer balance sheets that hold the entire structure together. Today, we're taking all of that and we're bringing it straight into valuation. Because there's a debate, an old one, that shows up in every cycle. What drives valuations more, the discount rate or the growth rate? Textbooks often pretend both are equal inputs. Markets don't behave that way. So today, we unpack how liquidity cycles, funding markets, risk premiums, and macro narratives flow into the numbers that analysts use every day. Let's get into it. In a traditional valuation model, you have two core ingredients per se. You have number one, expected future cash flows. This is the growth story, I call it. Then you have the discount rate, which is the risk story. Finance professors will tell you growth determines the numerator. Discount rates determine the denominator. And price is just the ratio between them. But in practice, markets don't treat these two inputs equally. Growth stories change slowly. Discount rates change fast. And liquidity changes even faster, especially in today's world, which we've done an episode on this, the fast changing environment and specifically in the context of bank runs. But this is the first big insight when it comes to what we're talking about today. Growth is a narrative. Discount rates are plumbing. Narratives drift, but plumbing breaks, right? So let's start with growth. Growth is technology, productivity, market share, margins, expansion, competitive advantage. It's about the future. What could this business become? Growth drives tech booms, hype cycles, thematic trades, right? And long-term optimism. But here's the catch. Growth stories are easy to sketch and slow to correct. Companies can miss expectations quarter after quarter and still maintain the high growth label because growth is ultimately a belief, a story. It's, sticky, you could say. So, but the discount rate, that's different. The discount rate reflects interest rates, funding conditions, risk premiums, spreads, and these can change overnight. The discount rate is nothing more than the cost of taking risk in the funding environment you're in. That's it. That's my personal definition. If liquidity is cheap, risk feels cheap, right? Discount rates fall, valuations rise, and if the liquidity is tight, risk feels expensive. Discount rates rise, valuations fall. This is fast, very, very mechanical. And it's just really simply balance sheet math. Discount rates move markets today. And here's one of the most important distinctions. Growth is slow moving. Discount rates are hyper reactive, which means when investors talk about a rotation, they're really talking about discount rate regimes. When markets melt down on no earnings news, that's a discount rate shock, not a growth shock. When tech stocks go parabolic without earnings, that's liquidity chasing duration, not cash flow changes, right? So if you understand discount rate dynamics, you understand most market behavior. So let's be a little bit fair, I guess, here. So there are times when growth dominates the conversation. Growth becomes the primary driver when liquidity is abundant, funding costs are anchored, and dealers have capacity. In these environments, markets don't care about risk. So they focus on winners, narratives, potential, scalability, disruption. This is why bull markets feel optimistic. When discount rates are low, the market magnifies growth. This is late 1990s tech. This is 2017 to 2021. This is any environment where money is cheap. But notice, the growth wasn't new. The discount rate regime changed. So discount rates dominate when liquidity starts to tighten. You see repo seize. When volatility spikes, dollar funding becomes scarce, so on and so forth. In these moments, the denominator collapses future dreams before the numerator even gets a chance. This is why markets can sell off even when earnings are fine. This is why value versus growth cycles exist. This is why the entire market can re-rate in weeks. The cash flows didn't change. The risk environment did. So let's connect kind of this money market view and valuation. So when we look at the money market, right, the side of things, the discount rate becomes, or the discount rate comes from liquidity and funding. Dealers set risk-bearing capacity. The cost of hedging influences asset prices, right? Markets are made through balance sheets. And so connecting that up with valuation, the discount rate is the required return. Risk premiums rise in uncertainty, and growth matters only relative to the discount rate. Growth is, and here's the fusion, growth is what investors want. Discount rates determine what they're willing to pay. The market really is a story about the gap between the two. Discount rates set the stage. And I would say growth determines the actors, the cast. You need both, though. But only one can change the valuation multiple instantly. Only one can reprice the entire market in a single afternoon. Only one is tied to repo, shadow banking, hedging flows, dollar liquidity. And that one is the discount rate. So which drives valuation cycles? I'll give you the clean answer. Discount rates drive market cycles. Growth rates drive stock selection within those two cycles. Okay? So cycles belong to liquidity. Winners belong to growth. Big macro turns, discount rate, I would say. Sector, when we're talking about sector or company outperformance, growth rate. Valuation booms, discount rate compression. Valuation collapse, the inverse, like we've talked about, discount rate spike. Stock to stock differentiation, growth rate dispersion. I think that's the map. I really do. I want to thank you for listening to episode 45 of the Global Ledger. We bridged the world of money and the world of valuation a little bit, and uncovered one of the most misunderstood drivers of asset prices. In the next episode, we look at another long-standing question in finance. And that is CAPM a model of markets or a model of funding? And I'll just give you a little spoiler. It's a lot more about funding than you might think. Once again, I'm Justin, and thanks for being here.